Hi everyone, I'm Sharyn, Investor Engagement Manager at the Good Food Institute. I'm thrilled to welcome you to this session where we're going to discuss how to finance the manufacturing scale-up of alternative proteins. Alternative protein production is capital intensive. It requires high investment upfront to fund the financing of equipment and manufacturing facilities. In fact, as you can see on the slide, it can cost anywhere between $1 to $4.5 million per million metric ton of production capacity for these facilities. That means to get to just 2.5% of global volume of meat share by 2030, we're going to need tens of billions, if not hundreds of billions of investment, depending on the product mix that we're producing. Unlike other industries that have this challenge, right, and we're not unique in that, we are quite nascent, and that means that equity investors in particular, or investors in general, can view these types of investments as quite risky. In addition, as we all know, it's been a challenging equity fundraising environment for the last year, and that's not just for alternative proteins, but across various sectors. But equity was never the ideal type of financing to scale equipment and manufacturing facilities. And so this presents a very real challenge. That's why we are so lucky to be joined by 4 experts that are going to share their ideas for how we can start overcoming some of these challenges. So first, we're going to have Matt Lucas of Tuatara Development Capital, who's going to introduce project finance and talk about it as a tool to scale this financing. Next, we're going to have Christina Sewell of S&P Global, who's going to bring green bonds to the table, a newer instrument that she thinks has been underutilized by our industry. Third, Brentan is going to talk about, of Synonym, is going to talk about techno-economic analyses and how they can be used as a tool to become bankable for startups across various financing options. And last, but certainly not least, Tubb of Synthesis Capital will illuminate lessons learned from the electric vehicle industry from their scale-up and their financing. We're going to have a series of mini presentations that's going to be some really hard-hitting data, so pay attention. And we're going to have time at the end of each presentation for a few audience questions, so please be thinking of those as we go along. And with that, I'll turn it over to you. You might need to raise that.
All right, there we go. Excellent. My name is Matt. I lead Tuatara Development Capital, and our mission is to fund and provide operating support to frontier technologies as they're building their first and future commercial facilities. Now, I want to provide context for this talk by using the valleys of death. In particular, I want to talk about the third valley of death. That's the one between demonstration and deployment. Look, I know there's lots of valleys of death and lots of things go wrong, but this is the one we're going to focus on today. And in particular, this is where you go from being a technology developer to being a project developer. It also means that you're moving from your sources of capital are changing. You're going from government and venture capital to project finance. And you notice there's a little bit of a gap in there. That's what project development capital is, or to be a little bit more pithy, it's what we call the dev cap gap. And not to bury the lead, but that's what my firm funds. So we hope we're pretty critical. Now, so what's the problem here? I know I'm preaching to the choir here. There's no existing asset class that provides the capital needed for these asset-heavy businesses. Now, that includes food tech, but also a whole bunch of other energy transition verticals to go from 0 to 1, and then 1 to 2 to 3 to 4. The growth venture folks don't have the quanta, the $100 million plus checks, and their return expectations are often misaligned with the returns that you're going to realize from real facilities. Private equity is often looking for passive investments and pre-existing cash flows. Guys, there's no EBITDA if you haven't built your plant already. And ultimately, what we want to do is unlock infrastructure equity. Infrastructure equity is low-cost capital, but it's low cost because it's low risk. Remember, these folks are dealing with pension money, and we don't want to be yo-yoing retirees' savings. Now, what we're going to be doing with project financing now is figuring out how to de-risk you to get you from venture risk to pension risk. Now, just to finish level setting, there's 2 ways that you can structure and capitalize an asset-intensive business: balance sheet financing and project financing. Balance Balance sheet financing is what you would do if you were a large company. You have a topco, that's in green, and then that topco has investors and lenders, and it has customers. And if that topco is going to build a facility, they're going to do so as part of topco. And whether that factory is biomass fermentation or precision fermentation or plant-based agriculture, doesn't matter. Just it's an industrial facility. This chart would look the same if I was building a solar farm. Now, the difference in project financing is you see that the factory and the topco are separate. In finance speak, you say they're non-recourse. If one of them goes bankrupt, the other one continues on its merry way. Now, this distinction seems really minor on a PowerPoint slide, but it has incredible implications. The first point, and most important, is that the factory can look creditworthy, bankable, and investable, even if the topco is something like capitalized startup. Why? Because that factory has all those commercial relationships. It's got that customer relationship. It's got its own investors. So if the venture-backed topco goes bust, it doesn't matter. The factory continues on its way. The second is that the factory is the one getting the money. So as opposed to the balance sheet where the topco is being diluted, in this case, the topco in project financing, the topco is not getting diluted. So that's real good if you're venture-backed and your venture investors are worried about a whole bunch of dilution. And the third thing is that this aligns the returns that are going to come out of a real honest-to-God industrial facility with the return expectations for your investors. In balance sheet financing, we might be using 100% equity at the topco with a 30% expected IRR. I don't think that there's any factory in the world, food tech or otherwise, that returns a 30% IRR. But if you do this in project financing with a mix of debt and equity, you get a 14% weighted average cost of capital. And in our professional experience, that's totally achievable. Now, I've been using this term project finance, capital P, capital F. I want to be clear. This is not just finance for a project. It's a very particular commercial, legal, and multi-part capital structure. So don't walk up to somebody and say, oh yeah, give me some of that project finance money, right? You don't just use that in lieu of venture capital, right? In fact, this is a very particular structure. You have to plan for this up front. In particular, we're focused on the fact that the project, that's the factory, and the person developing it, referred to as the sponsor, are separate entities. And what that means is that the factory, somewhat counterintuitively, can be more investable than you, the startup. And that's intentional. I want to be clear that we're not venture debt, we're not equipment leasing, we're not private equity, we're not bank loans. I'm happy to disambiguate that offline. None of those things provide the benefits of project financing. We're talking about raising capital in massive quantities. In general, this starts at $100 million. We're talking about pulling down return expectations to a level that are consistent with the real returns from a real industrial facility. We're talking about minimizing or avoiding crushing dilution, especially to a venture-backed company. And here's an added bonus. The venture-backed company gets ARR because of the licensing and royalty fees. Now, again, these are all just benefits of project financing, and these would accrue to you regardless of whether you are a food tech company or a solar developer or sustainable biofuel. Now, I didn't invent project financing. This has been around for almost 100 years. 1.0 was civil infrastructure. This is really low risk because most of these things had government backstops. Worst case scenario, the government raises taxes, the investors get paid. 2.0 was power infrastructure. This is great. And the big change here was that we were able to remove the government as an intermediary. So here we had private power plants, first fossil power plants, and now renewable power plants. And these were just bilateral private transactions. We had a private power plant contracting with a private utility. And the reason this worked is because the utility could guarantee the power plant a return. There was this long-term fixed price contract for the power that was going to come out of the power plant. Where I see the world going is a third wave. We call this non-power industrials, and this project finance 3.0 is the goal of Tuatara Development Capital. A number of these frontier and emerging technology verticals are the ones that we focus on, and a number of them overlap with food tech and GFI's mission. So what do we do as Tuatara Development Capital to enable this? Our goal here is to help you bridge the dev cap gap from venture risk to pension risk. So part of that is funding, but part of that is providing you the operating support to go through the de-risking process. That's both a technical de-risking and a commercial de-risking to help you go from this kind of risk to this kind of risk. And by taking your risk down, you access lower cost capital. Now, I don't have a great analogy for this, so you just get a blue arrow, but there is a method to this madness. We call it the project development process. David, in the last presentation, presented on some of it, front-end loading and feed. That's a key part of the technical de-risking part of that process. There's also a coupled commercial process. Now, every project is a snowflake, so the saying goes. And so I want to continue this conversation one-on-one with each of you. But as you start thinking about this, there are going to be 4 key questions that you want to be thinking about. Number 1, where are you going to build this thing? Location, location, location. A lot of this has to do with access to feedstocks and transportation infrastructure. Number 2, what are you going to do? What if this can you offlay to an upstream partner or a downstream partner? Please don't try to do everything right out of the gate. Number 3, who's your supplier? Right? And this isn't just any supplier. This is a supplier that can provide you long-term contractual certainty. Most projects fail because their cost of inputs starts exceeding their cost of product. So you need to avoid that, what we call basis flip, and make sure that you have a margin baked in. And the last one, the off-taker. Off-take is a term of art in infrastructure finance for a long-term buyer. And the thing about this long-term buyer is that they're providing you contractual certainty that if you make it, they will buy it at a pre-specified price. So let me be clear, selling to a chef, not an offtake. Distributing to Whole Foods, not an offtake. You're like, well, wait, Whole Foods is a really big customer. Shouldn't that be a good thing? And it doesn't count. And the reason it doesn't count is because distributing to Whole Foods doesn't guarantee you that your product's going to get sold, and it doesn't guarantee you the price that it's going to get sold at. So this is probably the biggest issue in alternative protein and food tech. And that being said, I think this is a great place for entrepreneurial hustle. What are some things that you might think about here? Institutional food service. Aramark and Cisco are both investment grade entities. They might do offtake. You might try to go and corner the Archer Daniel Midland and the Louis Dreyfus folks, right? They're investment grade traders in the food and ag space. The other thing is get entrepreneurial. Walmart just signed its first offtake for indoor grown butter lettuce. There's a longer story about why they signed an offtake for butter lettuce, but it didn't have to do with the cost competitiveness of the butter lettuce. It had to do with the fact that they could be assured that the butter lettuce didn't have salmonella. So it was more of a PR issue. So all of these things are the keys to unlocking project finance and this off-balance sheet capital. Looking forward to continuing the conversation one-on-one. Questions? Shoot.
Especially for newer kinds of technologies.
Sure. So the question was about how do you mitigate technology risk? So the first thing is I want to be really clear. When you come to do a project financing, you've already piloted and demonstrated. So the risk that's being taken here is scale-up risk. That's an engineering risk, not a science risk, right? That's part one. When you go through a front-end loading and a feed process, that process, which David described in the previous presentation, is really good at ferreting out these points. The flip side is that you are going to pay more for a project financing in, say, alternative protein than you would for, say, a solar photovoltaic farm. In infrastructure speak, we talk about core and core plus. Bridges, roads, solar, that's core, lower cost of capital. Core plus would be alternative protein in these third wave type projects. We're still talking about a unlevered IRR in the mid-teens, so definitely more cost effective than private equity or an alternative. But again, everybody's technology is different, so what scale up means is sort of a bespoke one-off conversation. Okay, oh, one more, great.
So you talked a lot about the factory being kind of like the investment, right? And that kind of offloads the risk. I was curious for all these kind of cell ad companies, sometimes the process can be so different for the factory part of it that like, it's not like they could just be interchangeable, like from one company to another. So like how does that kind of affect?
So the factory is yours. It's bespoke. Let's be really clear about this. So I'm not talking about you dropping into a CM facility here. We're generally talking about post CM, right? And that the whole point of this factor is that you can customize it for your process with maximal efficiency with best unit economics. I wouldn't expect that. We're not talking about an interoperable facility at this point. We're talking about something fit for purpose. And because it's fit for purpose, we need to know that the product that comes out of it, your product, has a customer. And that's where the offtake and the suppliers really matter. Cool. All right, thanks.
Hi, everyone. It's great to see you. I'm Christina Sewell, and I'm representing S&P Global today. Let's go to the next slide here. And on our sustainable finance team, we conduct ESG research and provide second-party opinions for the sustainable labeled debt market. And I'm really excited to discuss how the growth of this asset class can potentially help scale up the alternative protein sector. So why sustainable labeled bonds and other debt? A few key reasons come to mind for this sector. First, attracting a broad ESG-focused investor base. Increasingly, we're seeing a lot of institutional and retail investors in fixed income that are starting their own environmental and social impact funds and using SPOs from S&P and other SPO providers to make decisions about what should be included in their portfolios. Funding for capital-intensive sustainability projects. We heard from Sharyn about just how much is necessary for the space to scale, given the fact that the average bond deal is anywhere from tens of millions to hundreds of millions in size, of course, dependent on the size of the company and the underwriting circumstances. But that can mean a lot of long-term investment towards the scale-up of production facilities, R&D activities, potentially for some of these bigger players, the acquisition of another alternative protein company in the space. We see a lot of potential cost savings over the life of the financing. I mean, it has been a little bit hit or miss in the last couple of years with the high interest rate environment that we've been in. But anecdotally, at least, we are hearing from issuers that we work with that they are seeing, at least a few basis points difference with sustainable labeled bonds versus conventional vanilla corporate financing. It can help with alignment with regulatory reporting trends. We're seeing from governments around the world, local all the way up to multinationals, a bigger focus on the climate transition, including how they're thinking about food and proteins. So, players that are starting to improve their sustainability reporting and getting on board with some of these projects can begin to align themselves more with these frameworks. It can help meet sustainability goals. We know that pretty much everyone who's here at Good Food Conference is really trying to solve big issues with the food system space, while sustainable labeled bonds and other debt is really here to help provide the financing for those solutions, specifically whether they're the big disruptive solutions like financing all proteins or improving, incremental ESG integration targets like improving one's scope 1 or 2 emissions. They can help a company enhance their reputation and their credibility. I think that goes without saying, but increasingly, for these big protein producers, this is increasingly something that we're hearing is important to them as their investors and their consumers alike begin to understand that the development of alternative proteins and the diversification of their portfolios into the space is very important to them. So how does S&P fit into this ecosystem? As you can see across various different divisions here, we have a lot of sustainability-oriented products for different kinds of clients. Today, I'm going to be zooming in on our second-party opinions for the sustainable labeled debt asset class, of which in the time that this product was released in 2020, we've issued now, actually, it's over 500 and are taking up about 20% of the market share. And just to ensure we're all on the level playing field here, these are just some fundamentals about SPOs, their point-in-time assessments, at least at S&P, that give market participants an idea about how an issuer's different transaction, instrument, its framework that includes a lot of various different sustainability-oriented programs are going to create some additional outcome in that sector. And then we make sure that they are aligned to these international voluntary disclosure guidelines like the International Capital Markets Association, green and social bond principles. And at S&P, we're looking at how these projects connect with a low carbon climate resilient future. This is a part of our methodology now, where we're really trying to make sure that all projects that we give that aligned stamp on are in line with a Paris aligned future. Wide scope of issuer types, including corporates and financial instruments, really anything under the fixed income umbrella. And again, once S&P and other SPO providers issue these to the market, they're oftentimes used to for institutional and retail investors to think about what to include in their ESG themed funds. Here's a look at the trajectory now of how this market has grown since the early days in 2018, and you can see that we surpassed 1 trillion in volume in 2021. There has been a bit of a lapse here given the high interest rate environment and some macroeconomic uncertainty we've seen in the last couple of years, but we do forecast the sustainable label debt market to reach 1 trillion, anywhere from 900 billion to 1 trillion again by the end of 2023, with green bonds leading the way. As for how that compares to the overall market, we're expecting it to hit 15%, which means it will have doubled since 2020 this year. This chart is a little bit off, but anyway, Europe continues to lead the way here with about 45% of this overall financing, followed closely by the APAC region. And that's actually North America there, coming in third at 15%. The issuer drivers of growth, this is really led by corporates. Corporates take about a third of this $1 trillion pie, and they are followed closely by international public finance and the financial services sector. Which then goes to show, with all of this hundreds of billions of dollars in sustainable label debt financing going towards corporate sustainability goals, how does that factor in for the food and agriculture space? Well, as you can see, about 20 to 23% of our total global emissions are associated with FLU, and yet, at least at S&P, we're only seeing about 6% of sustainable label debt opinions being related to this sector. And then that's not even touching alternative proteins at this point, which are really just onesie twosie coming in the door since last year, but more so focused on AFLU issuers in the agribusiness space who are trying to make these incremental adjustments to their supply chain, as well as some farm level technological advancements, agroforestry practices that they want to incorporate. But increasingly, the good news is we are seeing more issuers spanning the small to medium enterprises to large cap enter the space, both public and private entities. With that context in mind, let's dive a little bit deeper into how S&P conducts our SPOs. There are 3 core components here that we look at for use of proceeds. For the purposes of today, I'm going to focus in on the project financing analysis portion because this is the most relevant for green and sustainability bonds, which I think will be the most applicable to the alternative protein sector. And here you can see our shading scale from dark green all the way down to red. The important takeaway here is that anything within the green spectrum would be considered aligned and be issued that SPO in the affirmative by S&P, with the darker green activities representing those that are longer term solutions that will likely see by 2050 with little to no improvements along the way. Lighter green, you get into these financings that are necessary, we believe, in the near term, in the next 5 to 10 years, things like hybrid passenger vehicles, for instance, but that will likely no longer be present by 2050. And anything in the yellow, orange, and red categories we find to be unaligned in our methodology. And taking a little bit of a deeper dive here, the elements that lead to this overall shade represent our understanding of an issuer's and their project, their climate risk, as well as other environmental risks and benefits associated with that project financing, all of which are looked at within this perspective holistically of what jurisdiction they're running out of. What does the climate transition look like for that part of the world? Is it slower? Is it faster? And then also, how does the value chain factor in for any of the products that they are financing with this green bond or sustainability bond? And here I just have a couple of slides on, the different reasons why for the average alternative protein scale-up product or project, we would at S&P view these as potentially highly credible green or sustainability use of proceeds financings. Because of this food production deficit that we're bound to see by mid-century, I think, probably a lot of people in this room already know some of these
metrics, but these are the reasons why, including, the increased meat consumption that we're going to see over the next few decades. It really stands out that plant-based proteins, at least with the various independent life cycle assessments that are out there, can range from 30% to upwards of 93% less greenhouse gas emissions than their conventional animal protein counterparts. And there's also additional environmental benefits associated with that, to include antimicrobial risk, foodborne illness, and zoonotic disease risk reduction that we know are so closely aligned with the intensive livestock space. Oftentimes we see producers that are scaling up their alternative proteins being able to, capture this ESG story that they are lessening the amount of conversion of land to farmland and preserving soil and forest ecosystems that are so necessary for mitigating emissions and keeping up our biodiversity levels. And then lastly, here within our analysis, we look at jurisdiction and value chain. For the cell-based meat space in particular, we would like to see that an issuer who is financing a green or sustainability bond is looking at the regulatory clearance for the area that they plan to sell in, so that, we're understanding what the trajectory looks like within that space. Any regional emissions trading schemes that are beginning to incorporate AFOLU that could potentially be to the benefit of alternative proteins. Any transition or litigation risk that's present in the space, to include, animal welfare considerations, which are increasingly so important with Prop 12 in California, potentially making pork more expensive for consumers there. And then we look at consumer demand for meat and dairy. What do those trends look like? And what is the consumer elasticity of demand? How willing are consumers in that area going to be to replace and substitute their meat and dairy products with some of these alternative protein technologies? If that information exists, we'll take a look at it. Value chain considerations also look at the feasibility of scale, the energy efficiency across the entire supply chain. What is, any risk mitigation efforts that are being taken to maintain carbon sinks throughout the farm level practices, and any food safety concerns that stakeholders have and how those are being mitigated as well as product packaging, which, we know that that's a sustainability issue in and of itself. And so lastly, I just wanted to end on a case study here. This is a real life issuer, Orkla Foods, based out of Norway. They have revenues around 5 billion USD, and they've really, have a portfolio that's dedicated to raw fish materials, which are so, popular in the Norwegian area. But they did stand up a goal in 2021 to be one of the leaders in alternative proteins by 2030. And in line with this goal, they issued a green finance framework, which was looked at by Shades of Green, which is now merged with S&P Global. And in one of the project categories that they had within that framework, they talked about how they were investing in eco-efficient and circular economy products, which included investments in the refinancing of their various infrastructure and production facilities that supported these plant-based food brands, Naturally, which was the plant-based dairy category, and Anama for the plant-based meats that they sell. They also talked about how there would be no meat-based raw materials that would be incorporated in those facilities, and how the entire value chain for the soy and palm oil that was used in the incorporation of those products would be certified to at least RSPO for palm oil and RTRS for the soy, sourced from North America and Europe. And for all those reasons, they received a medium green. Probably could have gone into the darker green category if not for some governance issues with the framework. But here's just a snapshot of what their impact investing report looked like. That came out last year. Those two green bonds totaled 140 million, with 58 million of that dedicated to the plant-based protein production CapEx. That funded their facilities, the machines, equipment, and production lines throughout. And you can see here they also follow best practice by basing those life cycle emissions estimations against their conventional meat and dairy counterparts that they sell through Orkla Foods as well, using an independent life cycle emissions database based out of Sweden to get to those final figures. I hope that's useful to kind of get a sense of, what one of these examples looks like and what we take a look at S&P for our SPOs. And here are some useful links. I'm sure we can make them available to anyone who wants to do a little bit more digging into our approach. With that, I can take any questions that folks have. Anybody? Oh, yes. Did I see a hand? Okay. All right. Well, no worries. If you'd like to find me afterward, I'm going to be around. So thank you so much for your time today.
All right. Good afternoon. So I'm going to talk to you a bit today about de-risking your financing and meeting capital needs through techno-economic analyses. So our first two speakers here talked about pots of capital that might be available to you. I'm going to talk a bit about the analysis to do very early in your commercialization journey to make sure there's a way to get from here to there, because no investor wants to invest in anything that's going to lose them money. So who am I? I'm Brentan Alexander. I'm the CIO at Synonym. Started as a technologist, moved over into the finance world when I made a long turn at one point in my life. At Synonym, we're focused on this $30 trillion problem. Global output attributed to biomanufacturing is going to be huge. That's beyond just alternative proteins. All biomanufactured products will be an enormous market by 2030. And to get there, we're going to have to build a whole bunch of stuff. And so getting to 30 million means scaling up a lot of strains, and it also means building an enormous amount of new capacity. So synthetic biology companies, they need to have biomanufacturing infrastructure, obviously, to bring their products to market. At Synonym, we are focused on financing and developing that biomanufacturing infrastructure to enable the products of tomorrow. So this has been talked about from some of the speakers earlier as well. Getting to profitable commercial scale production, it is a long, complex, arduous, expensive journey, right? You start out at the pilot and demo scale. That's even after you've been in the lab for a number of years. At that point, you need to find flexible scale-up space. That might be at a CMO. That's going to be millions of dollars. Once you reach some commercial traction and you need to have more capacity, if you start thinking about dedicated capacity, you need to spend many millions of more dollars just doing some of that early FEL and feed work to even be ready to be thinking about building a facility. And that just gets you to the point where you need to raise hundreds of millions of dollars to actually build that facility itself. It's long, it's expensive, it's arduous. At Synonym, we're aimed at building a platform to enable that, to make it more efficient and less capital intensive. We've built a team of folks who've done project development and project finance work over our careers to streamline that scale-up journey to help move from pilot and demo to commercial scale, helping map the capacity journey, the optimum times to move up from different capacity sizes as you grow, helping match folks with capacity that may be available in the market today, and finally helping with actually developing that large-scale capacity for the future. So if you're ready to scale, you need to do techno-economic analyses, and that's what I'm going to be talking about for the rest of this talk. At Synonym, because we work with clients all the time that are scaling up their processes, we built our own internal underwriting models to understand the unit economics, the capital costs, the operating costs associated with various fermentation processes and what that would look like at scale. And we've made that TEA available to the community freely at Scalar, which I will talk about. So scalar means having capacity. Building capacity means attracting capital, as some of the speakers earlier talked about various capital sources. To attract capital, you have to be bankable. Bankable means someone will be willing to invest in you. And being bankable means you are underwritten, means you went through the diligence process where they validated that you're actually going to likely return the return profile necessary for your capital source. So to understand whether you're underwritten, you need to answer some questions. You need to quantify costs. What are your operating costs? What's the cost of labor? What's the cost of utilities? What's the cost of your overhead? What are the costs of actually building your facility? What's the capital cost? You need to understand your resilience. How do those costs change under various scenarios? If your feedstock price goes up 20%, what does that do to your return profile? What are the primary risk drivers that could impact the profitability of your business? And you need to validate the returns. So when you look at all those costs, when you look at that resilience, what scale do you need to reach before you're actually profitable? And will the pricing that you can command in the marketplace from your off-takers, the term that Matt used, will that be enough to actually generate the returns necessary to attract financiers? And that's the point of using techno-economic analysis, and that's why we built Scalar. So Scalar is a next generation techno-economic model. It gives critical insights to understand the bankability of fermented products in the marketplace. So that's available right now at scalar.bio. Anyone can use it. It's free to use. It's free to run TEAs on. The model itself has 50 plus adjustable parameters that runs the gamut between technical parameters associated with your process. What is your DSP? What size of tank are you using? It also includes commercial parameters. What is the cost of debt? What's the cost of equity? Many of these parameters we have defaults provided. So if you don't know, we provide our best guess of what's likely to be available in the marketplace. And from those 50 parameters, which span, like I said, product, facility size and timeline, DSP, medium components, we produce 10 KPIs for your actual bioprocess. So these are critical KPIs to understand whether your process is ready for commercialization and is something that's likely to attract investors. So one of the first things we calculate is capital cost. How much does it actually cost to build a greenfield new build facility for the product that you hope to manufacture at the scale you hope to manufacture at? We calculate the cost of production. So how much is it actually going to cost to operate on a $ per kilogram basis based on the amount of feedstock you need and the amount of power you need and the amount of water you will need and the amount of wastewater treatment that you will need. And then we run sensitivity analysis to identify the profitability drivers. So for many of those key inputs, if they vary plus or minus 20%, what does that do to your profitability? So you can understand what are the key inputs to your process that actually impact your profitability as a company. So we launched this about 3 months ago, and since that time, we've generated over 1,500 custom TEAs for, I hope, many folks in this room, and want to give a sample of some of the information we're getting out of the system to date. And so first, people love using it. Here's some quotes from people who've used it. It's a great tool. Please use it. So some key insights, right? First, in terms of the users of our platform right now, predominantly precision fermentation. It does support both biomass and precision fermentation. We're seeing that a majority of the startups that are in our system and using it come from the precision side. We're also seeing that as people think about their commercial scale production, there seems to be a sweet spot between the 50 to 200 cubic meter in terms of tank size that companies are aiming for. And so at Synonym, we believe this is important because one of the key things that we're doing in our development process for new facilities is thinking about key standards for the fermentation industry that will enable further capital formation in the space by bringing some level of fungibility to the asset so that things like offtake don't have as much importance, so that the same facility could serve multiple people. And so that means having standard tank sizes, standard processes that the whole industry can organize around are important. And what we're seeing is that 50 to 200 cubic meter as the production size seems to be where people are focusing. Total volume. So if you're at 50 to 200 per tank, we're seeing total volumes roughly 4 to 8 times that. So 4 to 8 tanks per facility. And the last key piece that I think is interesting is target sales price. You know, over 75% of users of the platform are targeting a sales price below $50 per kilogram. And so that reinforces the importance of really understanding your TEA. Because below $50 per kilogram, we're really targeting large scale markets with commodity type pricing, where the difference between a $200 million and a $300 million facility could make or break the business case. And so having a really core understanding of your capital costs, of your operating costs are key to make sure that your process is going to be a 20% IRR instead of a 0% IRR. So to give some quick insight into how the model works, how do we get from A to B inside the Scalar model? I'll go through this really quickly. We have a webinar that we did with GFI about a month and a half ago where we spent much more time talking through the Scalar model itself and the intricacies of how it's working. But to give an overview, we start with technical inputs. And so we ask a series of questions about yield, about titer, to understand the technical inputs for your process. What DSP do you utilize? And then we take that and we turn it into a priced equipment list. And so we have an engineering team that has gone out, built their own heat and mass balance for a variety of types of facilities. We've gone out to suppliers, gotten quotes on various types of equipment, and we utilize your technical inputs against our priced equipment list, which we then scale up and down depending on your size to actually determine the total cost for a facility based on your needs. The next thing we do is we take those same technical inputs and we turn them into utility usages and feedstock usages. So how much power will you need to run the fermenters? How much power will you need to actually run the blowers? How much cooling water will you need? How much wastewater will you generate? And what's the cost associated with every single one of those utility streams? Right now, we base that on costs associated with the US Midwest, but any of those things are inputs. So if you have a different geography you're operating in where you know your costs, you can update that in the model. And so we calculate your operating costs and costs of production, so both CapEx and OpEx. We then take those total facility costs and calculate your financing needs. And this is a key piece of project finance, which is something that the scalar model is centered around, is the capital cost is one piece of actually building your facility, but then there's other soft costs, as we call them, on top of that. Costs for guarantees for your construction contractor to finish on time and on budget. Contingency costs. If you're raising debt, there'll be debt service reserve accounts you have to raise against. These soft costs can add 30 to 40% to the total cost of your project. And with your operating costs and our understanding of production level, we can then calculate your revenue and then subtract out those operating costs to figure out how much cash is left for the investor. And at the end of the day, you compare your cash for your investor against your financing costs to determine whether there's a bankable project there. So what Scalar will do in the end is we'll calculate how much revenue you generate, your fixed costs, your variable costs, the debt service and capital costs associated with actually building the facility and what's left over in terms of profit. And if that number is positive, you theoretically have a bankable project. Scalar obviously does not fully underwrite your technology to make sure it's ready for commercialization. It doesn't underwrite your commercial agreements to make sure they are actually bankable agreements. But step one, as you think about your commercialization journey, as you think about new products, as you think about new strains, TEA is incredibly important to make sure that if you were to get to the target KPIs you intend to get to, will you have a project at the price point you think you can sell at that actually generates returns that will attract an investor? And if the answer is no, that means you need to rethink the business strategy or the target KPIs or the technical level you intend to reach to actually attract that investment. So again, that's available today at scalar.bio. Happy to take any questions that folks have. You can also reach out to us at contact@synonym.bio to either learn more about Scalar or the work we do in project development and financing. I know contact@ looks like a dark hole email address that goes to a trash bin, but I assure you it goes to real people and we do answer it. So thank you for your time and happy to answer any questions.
With the 50 to 200 on the size of the fermentation tanks, do you think that that's a function of what is technologically and scientifically and practically optimal for these companies, or do you think that it might be a function of the sorts of financing things that they're solving for or other considerations that aren't related to actually what they're trying to produce?
Yeah, that's a great question. Because obviously we know there's folks out there fermenting in tanks considerably larger than that today. I don't know if I have great insight into why folks are sort of aiming at that level. You would expect long term as this industry grows and becomes very, very large that having much larger tanks matters and is important from a scale standpoint. The larger you get, the better your unit economics get. And the industry right now, in terms of the sizes we're at, probably supports things more in that 50 to 200 range. Also, in terms of scaling up your process, in terms of what you've run at today versus what you think is a reasonable step size to the next size, probably allows people to sort of aim at that size. Yeah, it's a fair point, although there's sort of interesting reasons why you might want to standardize around that anyway, including once you get above about 150 to 200 cubic meter, you have to stick build instead of actually building something in a fab that you can ship. Once you get above that size, the tank becomes too large to fit under bridges and those kinds of things. There could be all kinds of interesting reasons why that's actually a good size anyway. But it is a fair point. Great, thank you.
I'm going to stand here just to be different. Oh, right. So hi everyone, I'm going to really take a bit of a zoom out and run through some new work. So a world premiere we've done looking at what lessons investment in electric vehicles can actually teach us about alternative protein investing. So a note on my background and perhaps why I'm uniquely positioned to talk about this is that, you know, I write and have written about disruption and adoption S-curves and the parallels with other industries for the last few years. First at Rethink X, where I wrote a report in 2019 on the disruption of the cow, and more recently at Synthesis Capital. So this slide actually shows our alternative protein adoption forecast. This isn't specifically my focus today, but why is this relevant for electric vehicles? Well, to set the scene, electric vehicles are actually following this adoption trajectory now ahead of what we hope to see for alternative proteins. And we're definitely at the tipping point of adoption for electric vehicles. And this is just showing in the US, by the way. So you can see various forecasts have EVs as a percentage of new car sales reaching 10 to 20% in the next 3 years, shown by the red line there. And in terms of total car fleet, as to perhaps be expected, we're a little bit further way off, shown by the dotted red line. And you can see that adoption has really rapidly increased over the last 3 years. So the questions we want to ask is, what was the role of investment in getting us to that point, and understanding kind of perhaps key moments and drivers that are going to really help us accelerate the adoption of alternative proteins. So for the purposes of this analysis, we do understand that investment policy and regulation do really work together, but today we focus purely on investment. And to do this, we went back about 20 years to collect investment data across electric vehicles and their supply chains. We wanted to understand how much has been invested, which part of the supply chain it was in, what type of funding, whether it was grants, loans, or equity, or even tax incentives, and of course, where the funding came from, so whether it was investors or government or industry. And would this show us any patterns or lessons we can actually take for accelerating the alternative protein investment? So we identified more than 200 opportunities totaling over $300 billion US, and this was just in the US. I do expect there are more. It wasn't an exhaustive search, but I think this gives us a really pretty good idea and understanding of the kind of funding that the industry has attracted over the last 20 years. And I think I was pretty surprised to realize how much of that investment has really been allocated in the last 3 years. You can really see that this decade, we're going to see more investment in electric vehicles than we've ever seen before in the previous 30 years. And that's a pretty astounding figure considering we're only 3 years into the decade. Now, thanks to GFI, we do have this data for alternative proteins as well. And globally, this number is not yet quite in the realm of electric vehicles, but you can see a similar pattern. The amount invested in this decade is already as much as has ever been invested in the space. And so over the next 7 years, we're going to see the total investment in alternative proteins likely hit the tens of billions of US dollars. Now, because I only have a short amount of time, I'm going to cover kind of 6 main conclusions from the analysis of the data, spanning really across 2 key areas of investment. So first, on the technology side, so investment focused much more on R&D, and then second on the commercial and industry scale up. And we see 3 key takeaways in each area. So first, technology advancements are really enabling the transformation of both transportation and food. So if we think about electrification and alternative proteins, these, in our view, are really technology-led transformations, and therefore are really both facilitated by improving underlying technologies. Now, for electric vehicles, it was really battery technology. But for alternative proteins, we're seeing this movement also as a technology-enabled transformation. And the technologies coming of age today are the ones we really need to produce meat and proteins outside the animal. And one way we can actually measure these technologies is through exponential cost decline. So the chart on the left shows the exponential fall in lithium-ion battery costs, which really helped unlock that EV use case. And this is also something we're seeing for key technologies in alternative proteins. So this chart on the right is from our proprietary database that we have. And we're seeing similar cost declines for cultivated meat production, as well as precision fermented protein production.
Another part of technology disruption is really understanding how they get better. So while costs are pretty easy to quantify, sometimes how can we measure improvement in products? So the data here that I've shamelessly taken from Hannah Ritchie shows how battery range, something that's perhaps a limiting factor for adoption in electric vehicles, has actually also improved over time. So, improving battery technology, lower costs, has also enabled longer range cars on the market and much more of them. This is also true for alternative proteins, where we've seen really innovation coming in waves. So, it's been around for 1,000 years in terms of tofu. And it was really only in the last century that we saw brands, more legacy brands like Quorn and Tofurkey, which were traditionally for vegetarian consumers. So not really a desire to attract an omnivorous or carnivorous eater. And this was really only changed in kind of the 2000s when Beyond Meat and Impossible were really founded with explicit objectives of replicating meat for and targeting that omnivorous consumer. And we see we're likely on the cusp of another significant step change, given the tailwinds behind the industry and the introduction of many enabling technologies such as cultivated meat, 3D printing, and many other technologies that you guys are all here today. And really looking at in an amazing way, really starting to unlock new levels of functionality and taste. The second point is that technology advancements just don't happen in silos. So this slide is from Rethink X, and it's really the idea that you need to take away from it is that we're in the midst of a multi-sector disruption and driven by kind of improvements in the load of underlying technologies which can converge to allow disruption in these key foundational sectors. And we do see this in the investment numbers. So for electric vehicles, a lot of the early government investment came from sectors like defense and energy, not necessarily transportation. And it's really that intersection between industries, which is what ends up being so disruptive. And for alternative proteins, we also need to be aware of these intersections, right? So everything from synthetic biology, of course, and information technology, but also we really see energy, clean energy as being another incredible enabler across not only electric vehicles, but also alternative proteins. The third point is that the future path is not always clear and they're going to be winners and losers. So I think going back through the data, it was really clear that less than 20 years ago, electric vehicles were not seen as the answer that we kind of perhaps understand today. So at the time, there was a momentum from legislators, the government, and even some industry players to really move away from gasoline and diesel. But EVs were not actually seen as the only or even the main solution. I would say that there are kind of three ways that would hope we'd move away from fossil fuels, which was through fuel conservation, so driving less, fuel efficiency, and alternative fuels, but more in terms of the hydrogen and biofuel realm. EVs were mentioned, but more in the context of hybrids, as no one really in 2004-05 saw full EVs as the answer. So you can see this in the investment numbers as well. Government and industry were not purely investing in electric vehicles, but they were financially backing these other technologies to the tune of hundreds or even billions of dollars. And when I was going through the data, it was really clear that I wasn't only recording successful investments, which should be expected. It's not always clear what the winning technologies are going to be. But there are, the EV industry has actually seen its fair share of failures as well. So one example that did jump out to me was Better Place, which was a company which at the time had this incredibly unique business model based on the idea of battery swapping. You drive into a station and the battery was kind of physically swapped, allowing for a much faster charging time. They raised a 350 million Series B, a 250 million Series C, and then they were bankrupt a year later. And why? Well, that technology improvement came into play. So better battery and charging technology just made that business model obsolete. And that's not the only example. I think alternative proteins will be the same. There are going to be winners and losers in this battle. And then the fourth finding, and kind of the first really around commercialization and scale up, is do alternative proteins need a Tesla moment to catalyze a kind of new wave of investment? So I think Tesla's impact on the electric vehicle market is kind of understood. There's no doubt that it was really, when they released their first sports car, the Model S, that it was a really pivotal moment. And it really showed the market, consumers, and importantly, the kind of existing car companies who had actually tried and abandoned full EVs just a few years earlier, that the technology could be de-risked, and attracted billions of dollars of investment in doing so. And the question for alternative proteins is, do we need a Tesla moment? Have we got a Tesla moment? What's it going to be? Is it going to be large scale cultivated meat production, for example? I mean, it hits some of the same notes.
Can we de-risk the technology? But the proof is really in the scale up. It's a high-end technology watershed moment for the industry. The costs are high, but will come down. And will consumers want it? It's kind of asking those key questions. I don't necessarily have the answer, but it's obviously something that, we continue to look at. The fifth point is around government investment and industry buy-in. They're going to be extremely important catalysts. So a real key takeaway from this analysis was being how in the early years, government funding was really a key driver for investment in clean energy, batteries, and the whole EV supply chain. And you can really see this from the chart with the bright or the less bright green and blue chunks that the investment has predominantly come from the government and industry. And we really saw two key periods which catalyzed investment from the government. First, Obama's 2009 American Recovery and Reinvestment Act, or the ARRA. And it was interestingly, this actually also came with the bailout of the GM Chrysler, which came with a caveat of a new focus on electrification, which I'll come back to in a minute. And then the second moment was the IIJA, the Infrastructure Investment and Jobs Act, and of course the IRA, the Inflation Reduction Act in 2021 from Biden. And so while the 2009 focus was much more on grants, the IRA has really allocated funding into loans, incentives, and grants, often to the industry itself. And this, of course, isn't the only funding going on in the space. As I've mentioned, the DOE has been active, and the US government generally invests in tech at the earlier point of adoption. And while we haven't yet had that kind of government buy-in for alternative proteins at the level of the IRA or even the ARA yet, how are we going to get there? And is the executive order announced last year just going to be the start of that kind of significant government move into funding? The other aspect is the industry buy-in. And as we've seen, this can be really strong. So once the technology is de-risked, so for EVs, the last 2 years in particular, has seen investment accelerate in part because of the IRA. But interestingly, this has been from all actors in the whole supply chain. So if you look at the chart on the right, you can see everything from mining, battery manufacturing to charging infrastructure and battery cycling, not just kind of EV production. So, you've seen a real buy-in from new and incumbent companies all through the supply chain. And I think an important thing to note, of course, is that once that buy-in comes, it comes really, really fast. An example of this is GM. So I mentioned how GM's bailout came with the caveat of electrification. They've really taken that to heart. So today they're active either through investments or partnerships across every area of the supply chain in North America, from raw materials to processing to cell components and full battery cell production. They've invested $50 million US in the Lithium Americas Thacker Pass project through equity investment and supply agreement. They even led the Series B round for Energy X, which isn't an Elon company, but a novel lithium extraction and refining technology company. And they've also got partnerships with EVgo and Tesla for charging agreements, and even led the Series A for Lithium, a lithium recycling company. So you can see many of these are really strategic partnerships. In fact, GM have announced spending of $35 billion US on scaling up and out their EV capabilities just through 2020 to 2025. Well, why? Well, they expect they're going to double their revenues to $300 billion by 2030. The question is, what could this look like for alternative proteins? We know corporates have started to buy them with partnerships, acquisitions, manufacturing, and R&D, but this is really quite small so far. This needs to be bigger and better and faster. So if we think about the numbers, GM are investing $35 billion between 2020 and 2025, and a back of the envelope calculation based on sales and profit would mean that JBS, Tyson, and Nestle could all invest between 10 and 20 billion US dollars in alternative proteins over a similar 5-year period. And this should really be our base level expectation. The final point is that there are investment opportunities all along the S-curve. And this is something that obviously we think about a little bit more as a VC investing in the space. And it's clear we see from the amount of investment going into the space that it does happen through all parts of the supply chain. And something we've seen for electric vehicles on the left-hand chart, how it's kind of almost moving away just from electric vehicles, much more into things like component manufacturing infrastructure. And this is also something we expect to see in alternative proteins. So again, thanks to the guys from GFI kindly sharing this data with us. The graph on the right really shows how we're seeing small signs of this already, with investment shifting from a kind of full stack product model much more into that supply chain. And that's something that we're going to continue to kind of track and watch going forward as the industry matures. So these are our 6 takeaways, but I did want to make a final point and that a global perspective is really important to this. You know, the US are not leading adoption in electric vehicles, and in fact, nowhere even near the top, as shown by the red lines here. And this has not stopped investment coming into the space. And something I haven't referred to much is legislation, where in electric vehicles, the US really had to play catch up. And in this aspect, alternative proteins, the US is really ideally positioned to be a world leader. But something to be aware of is that despite this, the US consumer is perhaps a higher barrier to entry. And the US in general, probably not people in this room, like their big cars and their big stakes. So as the technology gets closer to consumer acceptance, these different market barriers are going to become a little bit more important and nuanced. So for example, in the US, perhaps being able to have an electric SUV or truck, and for alternative proteins, having that kind of full barbecue steak experience is going to become more important. So in conclusion, we see kind of three main points. First, that tech improvements are vital. Scale up, de-risking, the product needs to become better and cheaper. First of all, a second point is the money is there. How are we going to get that government and industry buy-in? And I really want to highlight again some of the numbers in the current industry. So in current livestock farming in the US, they spend $40 billion a year just on CapEx. That's a huge amount of money that could easily be transitioned to alternative proteins. And then finally, the role of VC. So I am a VC, we are in VC, and I'm kind of advocating here for investment from other parts of the supply chain. And that's because VC has a role, and we want to make sure that we are acting very importantly, mainly in the role that we should be in those kind of newer and emerging technologies. Thank you, and you can email me directly. No questions?
Thank you, all the speakers. So I know I told you it was going to be information packed. I think the lack of questions or the low questions is not because it wasn't excellent content, but maybe others like me want to watch the recording of these sessions a few times. And that's our fault. We gave these speakers 15 minutes to just provide so much information, but we wanted to get all of it to you because what's clear is that there are just such a wide range of potential solutions to this really challenging problem. The solutions also go beyond even what we discussed here. For example, last week, GFI hosted a webinar with the Department of Energy Loan Program Office. That's an opportunity that companies should explore if they haven't. So we have this big problem, this big money problem, but there are a lot of solutions and so many smart minds, passionate people that are pursuing them and here to help you. So whether you are a smaller scale startup or a large CPG and meat company in the room, I hope you took something away here, a next step you can take. And I think it's important to say, especially with Brentan's point on techno-economic analyses, it's never too early to start thinking ahead to this type of financing that you're going to need when you succeed, when you scale. You need to make steps early in your business, take steps to really prepare for this kind of financing.